Megaport spent most of 2026 underwater, down year-to-date before May 14th, and the prevailing read on it was a growth story failing its own execution. Then a single announcement erased all of that in one session, which raises the question of whether the announcement resolved the thesis problem or simply deferred it. The stock had touched one-year closing lows on April 10th. By the May 14th close, it had recovered 96% from that trough, the bulk of it in a single day. The number doing the work here is not the 33% session gain. That is the market's vote. The number that matters is AUD $90.6 million in annualized recurring revenue, which is the contracted cash claim that forced the vote. What changed is not Megaport's positioning statement about AI infrastructure. Management had been making that case for over a year. What changed is that AUD $254 million in signed fixed-term contracts converted the positioning statement into a liability on someone else's balance sheet. The bear case had been that Megaport's pivot toward AI compute, anchored in the June 2025 acquisition of Latitude.sh, was directionally correct but commercially unproven. The company was carrying execution risk with no committed revenue to validate the strategy at scale. 2 contracts at 36-month terms and 1 at 24 months, covering approximately 90% of the total contract value in the longer structure, answered the duration question the bears had been holding. That is the frame inversion, not a narrative shift, but a contractual one. The mechanism that moved capital is not enthusiasm for AI infrastructure in the abstract. NVIDIA's market cap was already past USD $5.5 trillion on the same day, and the ASX was flat. Capital moved specifically because the revenue is now term-locked, not usage-dependent, which changes the discount rate applied to Megaport's forward cash flows rather than the growth multiple. Yet the inversion surfaces its own unresolved question. Term-locked revenue requires USD $101 million in upfront capital expenditure, and the terms of that funding determine whether the margin structure the market just priced is actually achievable.
The detail that most coverage compressed into a single line is the one that most directly determines whether the repricing holds. Megaport committed approximately $101 million, AUD $140.3 million, in new capital expenditure, primarily NVIDIA GPU-based high-performance compute infrastructure to fulfill the contracts. The company is funding this through existing cash reserves and a newly upsized $150 million debt facility with no immediate equity issuance. That structure preserved the existing share count, which is the reason the session gain was not immediately diluted away. But the more important element, the one that analysts tracking pure ARR build did not foreground, is what happens to those GPU clusters at contract expiration. At the end of each initial term, Megaport retains ownership of the hardware, which re-enters the Latitude.sh compute pool for redeployment, either as contract renewals or as on-demand capacity. The stated payback period on the capital is approximately 2 years, against a contract base of 2 to 3 years, which means the hardware enters its residual life inside Megaport's platform before the initial contracts have fully expired. That residual asset structure is the countersignal to the debt overhang reading. The leverage incurred is not consumed on delivery. It is converted into a semi-permanent infrastructure position. One of the 2 contract customers was already an existing Megaport client, which means the upsell track record within the platform preceded this announcement, and the platform stickiness embedded in that expansion has not yet been priced into forward estimates. The condition that would break this structure is hardware delivery timing. Compute hardware orders are placed, with deployment expected on a phased basis starting in the first half of FY27. If delivery slips past that window, the ARR ramp is delayed, but the debt facilities held funds regardless, compressing the margin the market is currently valuing. That is the threshold risk, not the contract integrity, which is term-locked, but the gap between commitment date and revenue recognition date. What Morgan's did with that risk in its revised estimates is the axis on which the forward allocation question turns. Morgan's retained its buy rating and lifted its price target to AUD $15.50, against a share price of approximately AUD $12.63 at the time of the note, implying 23% further upside after the session gain had already been absorbed. The language in the note carries the argument that most market commentary flattened. Morgan specifically identified data center power constraints as the operating condition that made Megaport solutions structurally differentiated. The broker wrote that Megaport was uniquely able to stitch together multiple sites to provide consolidated inference solutions precisely because power constraints prevent single facility deployment at the scale these AI customers require. That framing repositions Megaport not as a cloud connectivity provider competing on price against larger hyperscalers, but as a multi-site orchestration layer that hyperscalers cannot replicate from within their own infrastructure.
The competitive substitution question, whether Amazon Web Services, Microsoft Azure, or Google Cloud can simply absorb these AI compute workloads directly, is answered by the power constraint, not by price. If a customer's inference requirement exceeds what any single data center can power, the customer needs a distributed deployment stitched together by a networking layer, and that is the market Megaport's combined Latitude.sh platform occupies. The sector reweighting implication is that Megaport's relevant peer group shifts. The prior comparison set was cloud-adjacent connectivity providers priced on network revenue multiples, but the contracted compute ARR pulls it toward infrastructure as a service comps with longer duration revenue and higher capital intensity. That multiple expansion is partially but not fully captured in the AUD $15.50 target. The FY26 revenue guidance of AUD $302 million to $317 million was set before this contract series was fully incorporated, and Morgan's estimate revision signals that the consensus revenue range will move again before the financial year closes. The benchmark for whether the repricing is durable, then, is not the session high. It is whether hardware delivery in late FY26 meets the timeline that makes AUD $90.6 million in annualized recurring revenue recognizable in the first half of FY27, which is the same condition introduced at the start of this analysis. Every day after the close, we publish a market wrap and key issue analysis. Subscribe to the channel.